Hi guys, welcome back to another lecture. Today we're going to talk a lot about the initial balance. Now I know in the previous lecture we covered a lot around value areas, so hopefully all of us understand what a value area is, implications of essentially trading around value. I hope we get that, and if you haven't seen the previous lecture, I suggest that you do that before coming in to tackle this one. Otherwise you're going to be lost. You're not going to know what's going on, you're not going to know anything, and you're just going to be hitting this video in what is lesson 9 and you ain't going to have a clue. So I will certainly implore you to go back and review the prior lecture, at the very least, right? I would expect you to start from lesson 1, but I do understand human beings sometimes don't do what they're told. So you're probably not going to start from lesson 1, but I would implore you start from lesson 1, work your way up. As long as you're here to learn and to grasp what's going on around market profile, then I would suggest you do that. If you're here for fun and you're probably never going to take this anywhere, you can start from wherever you want. It's not going to matter. You'd be probably logging off in about a few minutes anyway. I'm just being honest, guys. That's the fact. It's what tends to happen. I think of these, no one else teaches market profile on YouTube. So I think of these as a way that potentially could change your life and the way you look at the market and the way you structure what it is that you do. That said, I know not everyone's going to look at it that way. Not everyone takes training seriously, and for some people it's just a little bit of a muse, and that's okay. But if you're one of those people who want to make this into a career at some point and see the benefit it will give you at a point in your life where you probably can't participate in society in the way that they tell you to, you're going to want to do something different. And if that's the case, then this is the way to go. If you're a new trader, no problem. This is a really good place to start. It will save you so much time and a ton of money with courses, mentorships, or whatever it is you feel you need to do in order to become a trader. You're going to find that this will cut that learning curve short. It will feel like you're starting in the deep end because you're looking at a TPO chart and not candlestick chart, and you're a little bit confused. But stay with it. Don't be confused. Don't be worked up about it. This is the way to go. The good news is I've started from lesson 1 for these lecture series, all on market profile, so this will be a complete lecture series. I have a free market profile course that's available on Udemy. I've left the link in the description, so that will give you some of that foundation or basis that maybe the lecture series doesn't cover as well. If you want to do a little bit more than that, I've got a paid Udemy course, which is really cheap. Anyone who's used Udemy will know that it's not an arm and a leg to do one of those. It's literally a McDonald's, which is a little bit more in depth, and it's like a paid series on Udemy that is in depth a little bit more. These lecture series are like good follow-ons, but also good entry points for people who've never done anything with market profile. You're going to find these lectures are going to be so informative, and that it will incentivize you to at least dig deeper. A lot of people have trouble accessing TPO charts, and that's perfectly fine. If you can't get access to one for your platform, I've got this one developed for MetaTrader. It will cost you, but it's not an arm and a leg. And once you've got it, it's for life. So there's no monthly billing, nothing like that. I'll activate it for you for your MetaTrader 4, and you can use that. You can get almost any price feed you want on MetaTrader. So don't tell me that you need to use TradingView, you need to use some other platform. You can use them in tandem because you're just looking at the TPO chart on the MetaTrader, but you don't have to essentially have a TPO chart feed on TradingView. It's going to cost you more to do that. If you wanted to use some of the more specialist platforms like Sierra and Ninja, it's going to cost you. It's going to cost you a lot more than I would ask to have this for lifetime, right? Just point in case. So if you need it, just DM me. The Discord server is always popping on the left hand side of the screen, so just put that link into your browser and it will essentially take you to the invite page, and just click on it and you're in the Discord server. If you've never used Discord before, it's like super easy. It's literally an app. You can download it on your phone and you pretty much have access to the Discord. There's so many benefits from being in my free Discord because I share a lot of information there, something that genuinely helps traders. So, we're talking everything from positions, because I do a lot, in the trading arena. So I sell option premium, I do all the CFD stuff. I do futures because I have a futures fund. So I do a lot of things that I can provide a lot of insights for traders who are looking to go a little bit more down that professional route as well. So being in that server is going to be helpful for you. It's free. You don't have anything to lose. There's no marketing in there. I've worked tirelessly. Server's a bit tight for like a lot of conversation, but I've worked tirelessly to keep that server that way, just because marketers and spammers are a problem, right? Discord, they're just a problem. Some of them are going to be watching this YouTube video and finding a way to spam the comments to get you to buy something from them. Whether it's crypto, whatever, they're just going to be on it. There's nothing I can do about that. So again, I've got so many warnings on the Discord server, but I've really curated it so you shouldn't get hit by too many spammers. But if you're doing your DM or anybody pretending to be myself, just literally ignore them. I don't DM anyone. I've got no need to. I post up stuff. If you DM me directly, I will DM you. We can have a conversation but you have to initiate the contact. I won't be contacting you on the server. So there's not even a hope in hell that would happen, right? If you want my help, you come to me. I'm not going to you. I don't particularly need anything from you, but if you need my help, you come to me. Right? Hopefully that makes sense. Beyond that, if you want another layer, I've got a private members group, but you'll learn about that when you join the Discord server if you want to go down that route. Again, I'm open. I believe in helping people through this journey. It's a difficult one. There's not a lot of people help people out there. There's a lot of marketers, a lot of salespeople. That's fantastic. But if you want to do the trading stuff, like you want to make this like serious, then that's what I'm about. So this is where you need to be if that's what you want to do. All right. So last lecture, as I said, we dealt with value areas. This lecture, we're going to deal a lot more with the initial balance, and we're going to look at it against longer term cycles, and we're also going to look at it against shorter term cycles, right? So that it's clear. A lot of what I've developed, you're not going to see anywhere else, right? Even like in the market profile community, which is really, really small. You're not going to see anybody talking about it because there's just not a lot of experience. The institutional guys who've used it, the incentive to bring this to mass audience is really, really low. Like really low, because not only does it require that you understand trading to a certain level, if you're going to kind of just hop into it, essentially the barrier to entry is too high. It costs you to have a TPO chart, and that's enough for a lot of people to just be like, I'm not doing it. Simple as that. If the barrier to entry was lower, i.e. every platform, MetaTrade, everybody was willing to have this just as a standard default, and more people will use it. But that's not the case. It costs money, and the platforms that have it pre-built in often cost money. CKG, for example, can easily set you back $400 a month. Point in case. Right, so when you're talking about that kind of money, for most people, you're going to be a professional trader. It's not going to be a muse, right? I'm yet to see someone who'll spend $400 a month on a muse. It won't make sense. So I'm not expecting that, right? So I know the barrier to entry is high, which is why I have the TPO available for people who want to take this journey. But the other side of it is, I can more or less, to an extent, guarantee you're going to start to achieve a level of success. Just because now you're trading like a professional. The TPO chart forces you to do that, because there's just no way for you to get in. Look at the thing. How are you going to be like swinging it? How are you going to get your dopamine hit by trading 1 minute charts using this? It's going to be difficult. You're going to find it really hard, which essentially means that you are going to focus a lot more on meaningful price action, meaningful levels. You're going to spend less time now trying to catch that signal trader, right? You're going to spend less time trying to catch that small move, because now you get to see a bigger picture. Right, let's talk about the initial balance. Now on a weekly profile, there are two ways you can do this. you can go for a balance that is set for the first day of the week, or you can go for a balance that's set for the first 4 hours, right? Which is brilliant. I've chosen, for the purpose of this lecture, to use the balance that is set for the first 4 hours of the week. And I've done that because I want you to understand how important the balance is to determining how much potential profit, how much money you could make if you're directionally right. If you take into account some of the principles that we've discussed, it means that your executions will come almost always at a specific point, which will be around balance. And the reason for that is that when you look at the initial balance, either side of it, you are making the earliest trade you could possibly make against the volatility. And I'm going to explain that. So I'm going to take something that extends. So I'm going to be on the right side of the chart this time, so don't need to go to the left yet. We will do at some point. So I'm going to take this elongated trend week, right? This elongated profile where market opened down here and then we extended, right? And I want you to think about what we've learned and what we've spoken about as we go through this exercise. So I'm going to drop this stack, right? I'm going to put it, this was initially a bid stack from the prior week, right? So buyers stacked up here and then we got an extension. Now I'm going to split this rotation, right? And I'm going to open this panel here because it's going to be useful. Right, so this day, the total range was 282.2 pips. Right, that was the total range from the low to the high. Right, that was the range of the profile. So it's a 282 pip profile. The initial balance range was 53 pips. So the initial balance, high to low, as multiples of the entire range, is effectively 282 divided by 53. Right, that's about 5 times the balance. So the market extended in a week 5 times the balance. So that's obviously a pretty big extension, right? Typically we won't see that kind of extension, but this was a trend week. So in trend weeks we get a more elongated profile, so it's more times the balance. Right, so we saw a bid stack here, and then the market opened and closed and set the balance at A period. Now the point about the initial balance is that execution, once the balance is set, executions that are anywhere from 32, or let's say 30% to 50% of the balance, right? So that's the top third to the midpoint of the balance, or the bottom third to the midpoint. So anywhere in that level, so if you're bullish, anywhere from the top third to the midpoint is going to be an efficient price to take for someone with a directional bias. So we've set the balance and we closed, right? You can tell from that small little dot here. I don't know if you can see it clearly, but let me just zoom in. Right, see that little dot here, that was the close, right? So that was that first 4 hours where the market opened and closed, right? So that was about 6 p.m. So this is a 2 to 6 p.m. window. So that would have been a NASDAQ window, right? So that was there you go. So hopefully we can see that. So if we understand that that's the 4 p.m. window, the A period, the opening for the week on a Monday, right? Then we can see that the close here was pretty crucial to determining what we think this market's going to do. Because one, we closed over a bid stack. That's the first thing. Right, that's significant. Secondly, any pullbacks now will take us back into that bid stack, which becomes a good buying area. So if I'm able to get a trade somewhere around here, which will be the top third to the midpoint, and I'm able to proportion my risk somewhere below the value area, as an example, I've got a pretty good idea what this week is going to look like. I've got a 53 pip balance, and I'm thinking at the very least I should get 3 times that balance in a week. So I'm looking at about 155 ticks, and I'm executing the midpoint of that balance, and I'm pulling my stop out a little bit, right? So it's going to look a lot like this, about 71 ticks. So I know I'm going to get a 2 to 1 on a week at the very least. And if I get an extended week, where typically I can see about 250, even 300 pips that week, then I'm going to be doing pretty well. So the balance is kind of that point where at the earliest point in the week, the large money set the range. So that's where they test whether the market has the appetite to go long or it has the appetite to. Once that balance is set, everyone is going to do a trade who wants to get into this early that has insight you probably don't. They're going to want to do that trade round about that balance. There's going to be people looking for efficiency, so there's going to be liquidity draws to the low of that balance, and there's going to either be liquidity draws to the high of that balance if people want to get short. So the market opens and then closes with a strong balance like this. For me, that's an indication that this market wants to get long, right? So this being, this was a 6 to 10 window, right? So this being the 6 to 10 window, market opening, of course, 10 o'clock on a Monday, right? That's why we have this range here, right? So this B period is that midnight window to 4 a.m., right? And this is why everyone will look to be long. Remember, it's the week. So we've got a long time to hold this. Everyone's going to look to be long at that point. So now it becomes, where is the market going to find a degree of pressure that we would want to get out of our trade? Or at the very least, if we're still bullish by a certain point, we can start to build into a position. And I'm going to talk about that when we get to the money management side of things, right? So looking at what the initial balance is doing at any given point is really, really important, because it's probably going to allow you to position in such a way where you can get the maximum out of that trade. Now, of course, you might think, I might want to position just below the balance low, right? Just because of the way we've set up. That won't be a bad strategy, but there's a good chance that the market will drive and try and find liquidity here even before going higher. So there's that risk. So that's why I say go under the value area low. But if you want to keep it really tight and bring in that alpha, then that's a risk you're willing to take. It may mean you might have to get into a trade twice in order to capitalize on a move higher, right? Because it might come, stop you out, and then continue, and then you're going to have to find a new entry. But as long as you're doing the entries around the midpoint of the balance, you're generally fine. I think a lot of the time when we're doing entries that are not around the midpoint of the balance, where they're a little bit high, then it starts to get a little bit tricky. And you can easily tell where it's inefficient for you to trade directionally when we measure that from where the balance is. So if you look at how this price action developed on this week, if you were trading long from here, it was a bit of a wait and a lot of volatility. If you were trading long from here, it was the same thing. So the further we moved from the balance, the less efficient it was to get into a trade. So people are trying to trade as close to the balance as possible. That is the point, because the balance gives you that benchmark for you to know how far this market could travel relative to the risk you're deploying, because you're trading within where the biggest traders have set the range. And it's a tough place to get in, because the market's going to move rapidly and it's going to move decisively when it starts to get away from its balance. All right, I'll show you another example going back to last week. All right, and obviously we've got this week in discussion, and we'll talk about that as well. So again, here's another example. So we've now had the drive and we're now high, and we're doing a run on stops at this level, right? So we're above the highs, we're doing a run on stops. So our expectation is that once we run into those, we're going to start to go lower. So of course, even though the balance is set up and opened and it's breaking long, my bias is not going to be to get long on this balance. I'm looking for an opportunity to get short on this balance, because I'm expecting a drive back into the bid stack here, right? And we can see that. So I'm going to roll this up again. And if you don't remember what we spoke about in the last lecture about the market coming into these stacks as being good buying areas, then you should go back and have a look at that. But if you did, no problem, you probably understand what I meant when I said we're driving we're clearing stops. I'm expecting that once we've done a run on those stops, we're going to come back, and then if anything, support will be at a bid stack. So me getting long at this point as well against the gap in value is not healthy. So I would probably disregard trades that are pushing higher, right? And remember, if I want to get short and I don't expect the market's going to go long, then I'm expecting this market's going to drop by some 150 pips, give or take, from where the balance is set. And again, if you look at the total range of this, it's 178 pips, right? So it's not far off. And as we go up, we seek that liquidity, we drive back down in I period, right? And then we hold just towards the middle of the balance. So if I can get a position anywhere on the top third of this balance, right, that could be here, then my risk will just go above the high. And then I'm looking to trade this into the bid stack and I'm done. So again, it's a 50 pip risk. This thing moved about 127, so it's a little bit, it's about 2.1 to 2.5, right, which is good enough, and you can look to cut this trade about here. To be honest, you might have cut it even by 111, which is a decent 2-to-1 covering cost. So you don't have a problem if you understand the other dynamics. What we can't always do is use the initial balance in isolation of other factors. There is a way to do that, but you won't necessarily be doing that on a weekly profile. It's a lot easier to do that on an intraday, daily profile with 30 minutes or 1 hour rotations, as opposed to doing it on a weekly profile with a 4-hour rotation. It's a little bit harder to do. So we need a directional bias if we're trading a week. That's 100%. We need a directional bias. All right. So again, we've seen the market trade into that bid stack, and then we're pulling back out. So what we saw was a slight draw, the market being rescued at bids, and then we're going back up. So that's telling me that this market has more to do, and we're likely to deliver and run stops above last week's high. So this market is going higher, right? And you can already see that. And if you've been following everything we've been talking about, right, so now we're getting into the Chicago window, this should make a lot more sense, right? So I think we're going to go higher, right? That's my call, and we can review this on a different lecture and see where this ends up going. But this is the most likely place I think we're going to deliver to. Why do I say that? Because one, we're forming a dynamic bid stack that we're trading above at the moment. So that's a good indication that we're probably going to break up and then continue the distribution higher. We also have on our side an understanding of range. For now it's 107, so there's about at least another 50, 60 on an extended run on the week. Today is Wednesday, so we're getting cooling off on a week. So let's say there's another, potentially over Thursday, Friday, there's going to be maybe another 60 or 70 pips to claw in this. So in total, we're looking for this to be about 200 pips in range. So another effectively 100 pips that could develop in this week. So we got a lot of information to tell us that we're likely to go and run liquidity. Now, if I split this, right, again, you can see the same setup. So we had the bid stack here, right? We set it up, we closed lower. If we were gonna go lower, we should have opened and traded out this stack here, and then that would mean that we're gonna cascade lower. But that didn't happen. Instead, we opened, closed higher within the stack. So there's just not enough selling pressure here to convince me that this market's going to go short. So I would develop a long bias. And I want to trade from at least 50%, right, top third to the midpoint of this range. So from the moment we opened B and we did a few letters lower, I'll be looking to get long. Maybe about here, right? And at this point, I can have my stops under value low, which clears the bid stack entirely, or I can stretch it a little bit and have it under the low bid stack. But again, if I did that, it means I'm overestimating the market's extension for my profit. So instead, I'm going to just hang it just under here. That's where I would sit it, right? And by the way, point in case, I actually have a position in this for the long side, right? And I'll show you when it works out. I'll show you the deal map, so you can see that I had a position on this and I was expecting this to go up anyway. So I'm just not just showing you this. This is something that I was willing to back. right? Because again, this was just part of my own trade setup that I was willing to do. And at the end of the day, like I said, I trade cable a lot. That's my day-to-day business. So this asset I've got a really good handle on. So anyway, my expectation is we're going to go higher. So that's where I'd hang it. So all I'm looking for at that point is from that 42 tick level, I'm looking to push this to, say, a drawn liquidity, which should be about 129, 130, and then I'll be happy to let that one go. And I'm fairly certain if the price action continues that way, we're probably going to get that by the end of the week. Not very difficult. Not very difficult. It's just having the information. And that's why I'm here, and that's why I'm giving it to you. And I'm giving it to you for absolutely nothing. Hopefully, you could reward this kindness by letting other people know that this YouTube series exists. A lot of you are part of private groups. You're part of things that are genuinely misleading you. Why don't you tell people in these groups that, look, you could come and sit on this lecture series and see how it goes for you for your trading, as opposed to wasting your energy paying, whatever it is you pay per month in a room with a trader that you have to keep following consistently. You can never build your own ideas. You can never build your own strategies or systems. You're just hopelessly dependent on this individual who's probably not even doing what they say they're doing, right? But hey, that's a story for another day. So all I can ask is just share the information with others, bring them to the channel so we grow the channel. That's it. That's the greatest gift. It doesn't bother me if you don't join the Discord server. That's entirely up to you. It doesn't bother me if you're not part of the private membership group. It doesn't bother me if you don't DM me and say, hey, I want a mentorship. It doesn't bother me if you didn't buy the TPO profile, the TPO indicator. It's up to you. I can only give you the value, as Morpheus said in Matrix. I can only show you the door. You're gonna have to work through it. Right, that's it. That's the best I can do. Is I can show you the door. The old English saying is that you can take a horse to the pool, but you can't force it to drink. Is what it is. Right. So moving on. Let's take a look at the. I'm gonna look at something else now that should hopefully put some perspective on what we've discussed so far in the balance. Actually, no. Let me push back. And I'm going to talk to you guys again about wider balances. That's what I'm missing. So occasionally you would see the balances will tighten up and widen. If a balance widen tends to happen at the bottom and tops of markets generally. So when we've had a big day or a big move is about to develop, you would see a wider balance. For me, it's a benchmark of a degree of exhaustion. Once we start to see the balances expand, then for me, it's an indication that we have some exhaustion in the price action, right? And as a result, we're probably going to start to see the market move in an opposite direction to that balanced behavior. So let's take the most recent one that we can see, which is this one here. And if I open it up, what you're going to see is that we had a bid stack at a high and then we had an expansion, right? And that market just ran. Right, typically at this point, we're taking out a new high, so we're having a certain degree of a run on stops, but we don't know yet if we're going to come in and break and sit under this level, right? That's the key benchmark. If we're able to stay above where we think the stops are, then that's an indication as well the market's going to go higher. We should come and clear this and hold and continue to deliver lower. If we can't do that, then the market will just continue higher. So when you get these exhaustion moves, right, that's an indication that we're running some stops, but there might not be enough liquidity here for essentially this market to start delivering to look for sell stops at the bottom. So these buy stops that have been run might be a temporary measure, but we don't know that. And we can see there's some stack in here. So we're going to expect there's going to be a bit of support. So let me roll this down here. Right. And then if I sit this here, we have an indication of where we're going to start to see people jump in to buy these stacks. So we have this run here initially, right? And a wider balance. Whenever you see a wider balance, be prepared to fade that weak. So as soon as we go up and we see weakness, typically we start to see a problem when we're about 50% or so And I don't know if I've got a Fibonacci tool here, that would help, right? So we start to see that weakness when we're about at 50% or so that's 100 to 150, quite accurate. We should start to see some struggle. And as soon as we see that, and again, you don't need to use the Fibonacci to measure this. You can see it visually. You just have to do half of the balance. So the balance range is 190. So from this point to this point, it's about 65. So there you go. So you don't need a fib to measure and see if we're extending. Once we start to weaken in I period, you can see that weakness coming in. You can anticipate that we're going to move to the lower the balance to at least draw liquidity, which is what we did in M period. And we balanced for a little bit, and then we steadied ourselves, and then we ended up going a lot higher and then having a real draw on liquidity at this point. Right, so wide balances are an indication that the market is unlikely to go very far. Right, we're either at an exhaustion point and we should be looking to fade it. Now there are occasions where we get wide balances with a ton of volatility. So these are the unpredictable days. So a good example will be this, where we opened, huge balance, and then we start to break it and go lower. My instinct would be, again, for the same reasons, if we're about 50%, in this case, value low was a really good benchmark, you can see that here, then I'm going to be looking to fade this as soon as I see weakness. And that was evident from we hit this, struggled in F, G, H, I, J. So by J and K, I'm ready to get long, right? It's a no-brainer. And what am I looking to do is I want to just get it long enough to catch the high of the range. That's it, because I should see the drawn liquidity there. And if the market continues, we can't predict this, unpredictable volatility. So these events are not going to happen too often. If you go back on this profile, you're not going to see many days with wide balance and wide ranges, right? And even that, we tend to struggle to do 2 times the balance, right? Or double the balance. We go one and I don't know, just almost 1.98, and then the whole thing collapses. Again, to the other side, it was just about 1 time the balance, and then we were recovering. So the fade from value low was quite significant. And if I split this, you can see that it was purely a statistical benchmark reaction to value low, in terms of the market was a bit strained, right? So the volatility was very, very high, and as a consequence, it had to rein itself back. It's a different measure altogether. Right, and notice I'm doing all of this on a weekly profile. This is the week. I'm literally adjusting and taking positions on a week-to-week basis. And all I'm using to gauge that is the initial balance, right? How we're trading around it, and essentially what's going on around that balance. Right? So that was wider balances, and that's the only other thing you need to know in relation to initial balances. Again, you can adjust these and set them in different ways. Right? So let's pop to a short time frame of cable, and we'll look at the same. So here we see an initial balance, which is the Asia Open. That's the first part of trading. So that 10 o'clock window, that's where it's all happening. So again, you can use it as a reference. So the market breaks above or below the balance, you're long or short. That's one way. It's typically referred to as the opening range trades. Right? You can do this on London, you can do this on New York, you can do this on a lot of different asset classes. It'll be up to you to back test some of these things. I'm not going to sit here and tell you that you need to do X, Y, and Z. You back test it, you find that it is true, and then you decide what you want to do with it. So that's another way to view it, is also the opening ranges on the short time frames. All right, so typically, if you're a US trader, you're going to have a different view. So you would probably look at a balance relative to an 8 or 9 a.m. open in New York, for example, or you look at balance relative to Chicago. So it just really depends on your center. If you're in London, you look at a London balance. But ultimately, again, you want to look at what the balance does. So I'm going to use, because I know a lot of traders here are going to be able to at least follow a London session. So I'm going to change this to a London opening range balance, which would be typically 9 or 10 o'clock. I prefer 10, 8 a.m. because that actually clears any kind of weird discrepancies that might occur. Right, so I'm going to set it for that, and then going to change it. And the way the profile looks is also going to change because I've changed the start time on the balance, right? So now the profile starts in London as opposed to in Asia, where it was on the previous picture. So that's why you've seen a change in the way the chart sets up. So if I split that, you're going to see that this is 10 o'clock, so 8 a.m. in London, and that's the London opening range. Now, typically, you can see that once we broke the London range strategy is a really common one, right? Everyone's been trading that for years. I don't even think it works very well anymore, but it gives you a good benchmark. So again, what's the market doing at the London Open? What do we have above it? We have what looks like an offer stack, right? So the market's gone, built up some volume, and now it is moving lower. Second part, the trifecta volume, right? So that's in place. Did we see a draw on liquidity at any given period? Let's split this up, and can we see that? Okay, so we've got equal highs. So we've come in, we've got or triple tops or double tops, people call them different names, right? But we've got these equal highs on the profile. So we go up, we hit the highs, hit the highs, hit the highs. So we don't really clear any liquidity. We move lower, test this. So what that's telling me is that we're struggling to find buy stops to drive this lower. We're not seeing any liquidity draws. If we look at it relative to this period, let's split this, we can arguably say that there might have been a draw on this high, but from my perspective, there isn't, right? So we're struggling to find draws. The buy side liquidity is also not really successful, and then we close the market higher on this profile, so we've got a lot of volume here. And then we open and break lower. So immediately, from a London Open trade perspective, is you want to be sure a few letters in, that could be here, that could be here, right? And that's about 17, 16 pips. And then you're pretty much looking to get out about here, right? There's not a lot in this, just because the market's a little bit tight. If you push it, you might not get where you want. So you're looking at about a 2-to-1 coming out of London. Right, let's say the trade didn't work out for you. Right, you were looking for a longer target, this thing pushed up and held, and then now you're thinking, I'm going to get stopped out. Your stop should be above the range, which would be helpful. And hopefully, if you're not seeing any movement as we get into the later parts of the day, then which would have been more like what time? Let's have a look. 7. So by 7 o'clock, then you can get out of this trade with a small profit. So you wouldn't have necessarily lost money. And what do we have? We have another normal distribution, right? So on the way down, the market is being absorbed, and we can tell that because we're on the way down with a lot of normal distributions. We're opening prices above. It's not looking promising. At this point, that's today, and that's why we've gotten the breakout. So again, you can see we opened, went higher, took out the London liquidity to the bid stack, and went up. So again, when we open and start to trade lower, you're now within a bid stack. You want to wait, or you want to say, I'm buying the bid stack and I'll sit at the low of the day and I'm going to see if this thing's going to go up. Right, so it's quite difficult to use the London range as a breakout strategy anymore, just because it's been done so much that everyone knows it's been done. The algorithms are going to set for you. So the London ranges have been very inconsistent. Right, this would have been a weekend switchover, so this is a midnight range, right? But the London range has been very inconsistent, so we don't see a lot of volatility coming out of that London range anymore. Market trades comfortably around it. We're seeing a lot more liquidity draws back in and opening up opportunities on the other side. So the ranges are failing a lot more than they used to. So that is also a testament to the fact that the market is dynamic and it changes. We can't sit on our laurels. Some of these things will work for years and then they may well stop working. Right, so again, that's another use there of the initial balances. You can change the time sets to the period that you trade, and then you can look at how the market behaves around them. And as you can see, it's very consistent. We open the range, offer stack here, we take the liquidity, drive into the offer stack, and then sell off. Right, so there's not a high degree of respect for the range. Again, we see, let's have a look, that's a switchover, midnight range. So again, we see this one here, much tighter range. Again, what do? We go lower, we trade above that London range, we draw the liquidity out, and then we head short. And what are we doing that against? Well, we're doing that against an offer stack, right? That was coming out of midnight. And again, if you look at this day here, this was about the only directional day we got from the range, where we opened strongly the London range, and then we traded around it and then continued higher. Those days are not often. In fact, we did actually go and try and draw on stops at the highs, but then eventually we supported and then went up. So from a strategic point of view, I think you have to be a really good trader, much better trader than a beginner, to be attacking the London range as a way to judge and execute your trades, benchmark position. So this will be consistent to the left side of the chart, as it will be consistent to the right side of the chart. Okay, well, I'll take a pause on this lecture because I really just wanted to cover the initial balance. It's a subject by itself and it's not very well covered even in the market profile community. So it makes sense to cover that very strongly to show you as well that that is also a way effectively that people do look at the market. Any questions, guys? Don't forget to leave them in the questions, comments, DM me on the Discord server, whatever, anything, just leave it there. I'll be happy to respond. I'll respond to pretty much all the comments on the Discord. If you want to message me on Discord, just DM me. I'll respond to all the comments on the YouTube channel. Just put them in the comments. Again, I only respond to comments that are regarding profile. In fact, I won't even put comments up that are not regarding the lectures that we're doing. And also, if you want to say I'm doing a great job, I'll put those comments up. It's always great for the channel, but outside of that, any other comments are going to get binned because there's a lot of bot chats out there. Can't tell who's human, who's not, and some of them are some of the comments are ludicrous. So just so everyone knows, so comments will be responded to if they're genuine questions. I will see all the comments, right? And I'll be able to know who's a human because bots don't ask questions, they make comments. In any case, it's been awesome having you guys for another lecture. Till the next lecture, adios.